Hi, my name is Devin Peterson, and today I want to share with you what a QCD or Qualified Charitable Distribution is and how it relates to you. As a retirement income certified professional over the last several years, I have the opportunity to serve all of my clients and educate them on not only their personal finances, but also the changing landscape of finances around them, and particularly different tax opportunities on how they can be more efficient. As I serve clients, we often encourage them to consult with their other professionals, and particularly their tax consultants or CPAs. Because when it comes to saving tax dollars, it's almost as good as earning extra dollars in interest. I want to share with you briefly how I was introduced to a Qualified Charitable Distribution, or a QCD. And this happened several years ago when, in an annual review, one of my clients asked me and said, "Devin, do you know what a Qualified Charitable Distribution is? My tax consultant had mentioned it and said that we should look into it. Do you know anything about it?" And admittedly, I didn't. I had helped a lot of my clients with in-kind donations, setting up donor-advised funds, and determining the best withdrawal percentage from their retirement account so they didn't increase their Social Security taxation. We helped clients with that, but I just wasn't familiar with it. And so I reached out and got together with my client's tax preparer, or CPA, and sat down, and we actually did a 2-year look back with that client to determine how much in savings they would have saved if they would have just made their charitable donations a little bit differently, a little bit more tax efficient than before. And for that client, it ended up being a significant difference in tax savings. I think for them specifically, each year was different because they took different amounts out of their accounts, but it was $1,300 to $2,500 in tax savings each year that would have been less dollars that would have gone to the IRS. So that really got me passionate and interested in a Qualified Charitable Distribution and what type of effect it would have had on all of my other clients. And so today, as we talk about a QCD, there's 5 elements of a QCD that I've determined that it's beneficial for you to understand, to totally understand if this strategy is appropriate for you. And so these 5 elements are what we're going to talk about today is really what a Qualified Charitable Distribution is, the history of it, which will explain possibly why you have not heard about it before, the benefits that can be gained from it, the requirements to actually implement it, and then some eligibility, and determine for you as the listener if this is a specific strategy that would make sense for you. So listen towards the end of the video, because at the end of the video I'm going to share with you 5 additional simple steps on how to implement a Qualified Charitable Distribution in a very automatic, painless, easy way for you into retirement. The first element is what? What is a Qualified Charitable Distribution, or a QCD? A QCD is a direct distribution from an IRA to a qualified charity. And the key word here is direct, because it's when we get a direct distribution that we get all the tax savings or the tax preferred treatment when we make that distribution. Now, to illustrate what a QCD is, I have a simple example that I want to share with you that plays out 2 different types or ways that we can donate to charity. Now, this example is not exact, it's not perfect, it's not a perfect representation of how your tax bracket works and how your monies flow through into a charity, but it's good enough to illustrate the point of and the general characteristics of what a QCD actually is. And so there's a couple of fundamental things that I want to explain. So we're going to use 2 different scenarios. So this is you up at the top. This is the IRS that likes to take some of your retirement dollars. This is your IRA, or your retirement account, and this is the charity that you actually want to donate to. So in this example, the scenario is going to say very similar in both examples. We'll say in a specific tax year that you will have to take out $100 out of your retirement account or IRA. Now this will represent $100 that would come out as a RMD, or required minimum distribution. So in this example, you have to take $100 out of your IRA, and you are in a 20% tax bracket, And then you also have the desire to donate $75 to a charity of your choice. So let's play out the first scenario, which is the traditional way that we usually make a donation. And so a traditional way in retirement, if you had $100 inside of your IRA and you need to take out $100 to meet that required minimum distribution and also satisfy your charitable donations, what this would do is you would take this full $100 and you would put it in your bank account, naturally crossing the veil of taxation, so the full $100 is taxed. And so in this first example, you would have to pay tax first, and so 20% of $100 is $20. So before you do anything else, you're going to turn around and pay the IRS their portion of your $100 required minimum distribution. And then at that point, you're going to take $75 and you're going to pay to your charity of choice. Now, this has to be a qualified charity, and so any 503c charity would do, but as long as they have that status in the IRS, you're good. So you would pay your $75 donation to the charity, and you would end up with an Abraham Lincoln or a $5 bill. You would end up with 5% of that at the end of this first traditional way of giving. So what we're going to do next is give you the second way, or a better way, or a brighter way to be able to make a charitable donation. So we'll take all this back again. And so the same scenario applies. You still have $100 that needs to go out as an RMD. You are still in a 20% tax bracket, and you still want to make a $75 donation to your charity of choice. The only difference, though, you had chose to do a QCD to make that donation. And so what that means is inside of your IRA is you have this full $100, and before it comes to you and crosses the veil of taxation, you actually send that $75 directly to your charity. So notice I use the word direct. So this is important. It's going directly to them first. And so now your remaining $25 comes to you as a taxable distribution, and you're still in a 20% tax bracket, and so you turn around and pay 20% of 25, which is 5 to the IRS, and then you got to keep the remaining amount, which is this $20. So if you remember from the first example, you had an Abraham Lincoln up here, or you had a $5 bill, but now you have an Andrew Jackson, you have a $20 bill. The IRS had the 20, now they have the 5. So the fundamental difference of a QCD and how we pay our charitable contributions is really we pay directly to the charity first, which lowers the amount of taxable income that we have, which means less of a percentage to go to the IRS. The IRS is still happy. You're still in 20% tax bracket. You still paid them what their fair percentage was, but you're just doing it a better way or a brighter way on how you make your charitable distributions. So that's what QCD is. The second element that we want to talk about today is the history of a QCD. Now, I had mentioned you might not know a lot about a QCD. The reality is your tax consultant might not know a lot about a QCD, and your financial advisor might not know a lot about a QCD, just like we did before we started helping our clients walk through this tax strategy. And the reason is it has not been around for very long. So between 2006 and 2015, Congress had explored what a QCD might do to the tax code, and so it was a temporary part of the tax code, a few years on, a few years off, a few years on, a few years off, and so it was never really a strategy that a lot of tax consultants or financial advisors could zero in on and count on being there as a part of their retirement planning or financial planning with their clients. Now that all changed in 2015, December of 2015, when Congress passed the Protecting Americans from Tax Hikes Act that made it a permanent part of the tax code from then going forward. And so This has been around for several years, back to 2016, on and off. But don't feel bad if you missed out and you haven't truly leveraged an efficient way how to make your charitable distributions, because it hasn't really been a stable part of retirement planning up until now. But moving forward, if it makes sense for you and it seems like a good strategy, after consulting with your certified financial planner or your CPA, it is something that you can count on moving forward, because it's a permanent part of the tax code. So don't beat yourself up if you haven't taken advantage, but definitely take this as an opportunity to look into it further. All right, the third element in a QCD that we want to talk about is the benefits that are gained from it. Now, from the $100 example that we shared at the beginning, clearly you can see the biggest benefit is tax savings, more to you, less to the IRS. But describing those a little bit more, I want to use a terminology that's common when it comes to QCD, which is a perfect pre-tax contribution or perfect pre-tax benefit. For your retirement accounts, if you think about it from a pre-tax perspective, all of your accounts, they've accumulated value because of your contributions, your employer's contributions, and interest that it's earned on a tax-free basis, well, a pre-tax basis. And then now when we do a QCD, we're taking contributions and earnings that have not been taxed, and we're transferring that directly to a charity and permanently avoiding tax on your contributions and on your interest. So it's a perfect pre-tax scenario, pre-tax going in, pre-tax going out. And then the second benefit, it really reduces your taxable income on your tax forms. And so the benefit to that for a retiree like yourself into retirement is there's a lot of moving pieces with your taxes that all depend on what your taxable income is. The biggest one is the taxation of Social Security. If your income is lower, there's a lower percentage of your Social Security benefit that's taxed. If you have a higher income, it maxes out at 85% of your Social Security benefit is going to be taxed. And so if we can reduce your taxable income, there's going to be savings from a Social Security taxation perspective. It also has a positive effect on your Medicare premiums, keeping them down as much as you can, and also has a positive impact on the phase out of your itemized deductions, and then also the threshold for your medical deductions on your taxes. So there's a lot of great benefits when it comes to a QCD. The fourth element of a QCD that we wanted to talk about today were the requirements involved to actually implement a tax strategy like this. And so for a QCD, it has to be an IRA. Now, I don't know why, I don't know what the logic is with the IRS and the way that Congress wrote this in, but it has to be an IRA. If you have any type of retirement account, whether it's a 401k or a 403b or 457 plan or a TSP plan or a VIP plan or a Roth IRA, most of those, if not all of those, require a required minimum distribution. Every year you have to take a distribution out of those accounts. But with the QCD, the tax code actually reads that it has to and only can come out of an IRA. So not the end of the world. These can easily be converted in a direct rollover into an IRA. But if you try to keep your account as a 401k or 403b plan and take a distribution, send it directly to your charity, it's not going to work. It needs to be set up and come out of an IRA every year. The next requirement is you have to be 70 and a half on the time that the distribution goes from you to your charity. Not to be confused with the 70 and a half rule of the RMD that you have to wait. You can wait till the end of the year to take your RMD. On the day of the transfer, you have to be or have obtained the age of 70 and a half. But you can see with these next few how integrated the QCD is with the RMD rules, because the next rule here or next requirement is it has to be distributed before December 31st of that year. Just like your RMD has to be received by you to satisfy the RMD rule for that year. So the fourth element in here is they do limit, because there is a preferred tax treatment on this type of distribution, they do limit you, and I know this is kind of a hard limitation for you as a retiree, but they do limit you on $100,000 per year per person. So potentially, if both you and your spouse have an IRA, you potentially could both donate to $100,000 a year to a qualified charity. But they do limit you on that. And I hope those of you that are listening to this all take that to heart and start donating $100,000 to charity. That would make this world a great place. But that is a limitation and a requirement. And the last requirement on here is it has to be a qualified charity that you're donating to. Now, I say that because there's a lot of quote-unquote charities out there that you can contribute to or donate to, but you just need to make sure that they're actually a qualified charity, which according to the IRS, that means that they are a 501c3 entity or organization. It could be a church, it could be a school, it could be a university, it could be any number of giving organizations that help the homeless or hurricane victims, but just make sure and double check that it is a qualified charity. Now, the fifth and final element of a QCD that is important to understand is the eligibility of using this tax strategy into retirement. And a few of these points of eligibility are going to look similar to the requirements because a lot of them are the same. So for you as a retiree to be eligible, kind of goes without saying, you have to have an IRA to actually make a contribution out of, right? You have to have obtained age 70 and a half. You want to give. This tax strategy does no good if you don't actually want to give on a consistent basis, whether it's annually or monthly, to a qualified charity. And so you actually have to have the desire and want to give. And then another item here that can easily show you if you're a good candidate, and another item on here, I need to get a pause. Another item. And lastly, on eligibility, within your taxes, if you're taking the standard deduction, it only amplifies the taxable benefit for you into retirement. Now, in 2017, the new tax reform, the Trump tax reform, was passed that almost doubled the standard deduction for retirees. And so more than ever, this tax strategy, I think, will have a lot more benefit for retirees because of the changing environment around us with the new tax reform. So if you're taking the standard deduction already, this is absolutely going to be a good fit for you. If you're itemizing in 2018 and beyond, you might actually be taking the standard deduction, and then QCD is going to make even more sense for you. Now that we've had the chance to discuss the 5 fundamentals of what a QCD is, where the rubber hits the road is this a right strategy for me, and how do I implement it? At the beginning of this video, I mentioned if you stayed towards the end, I'd give you a quick process or a little secret on how to automate this to become easy and beneficial for your tax planning. And so here we go. Let me show you really quick. So at our firm, we have a process called Brighter Giving, which is a systematic process that we walk our clients through on how to efficiently use this strategy to implement on an annual basis or a monthly basis or however often they want to make their charitable donations. But initially what we do is we walk clients through this, number one, identifying if it's a good scenario for them. And so if you want to see for sure, look at your last 2 years of tax returns and kind of do the back the math into it and say, does this make sense for me? If I have this account and this RMD and I need to make these charitable donations, does it make sense for me? Do I save taxes? So identify if there's an opportunity there for you or not. And then the second one is position. Like I mentioned before, you have to have an IRA account. You might have all these retirement accounts that might need to be recharacterized or transferred over into an IRA. So we position that account in a place that can automatically and efficiently make those QCD donations to the charity of your choice church, hospital, university, etc. And then the third part of this brighter giving process is determining the timing of your donations. We have a lot of clients that pay 10% of their earnings or their income to the charity of their choice, and they want to do that monthly. And so we set up the process and the system so those go out automatically on a monthly basis. Some families just want to pay annually and they want it automatic. Some families just want to review it annually and make a donation amount at that point. But setting up the timing expectation is really important so you can plan appropriately to make sure your RMD comes out before the deadline. The fourth step is transfers. Setting a system up that's automatic and you don't have to think about it every month or every year, where you or your financial professional or your CPA can just implement it and not have to manage it, not have to worry about it, is usually the best way to do a QCD. But if there are different custodians of different accounts, those transfer forms need to be filled out and put into place, and so they happen automatically. And then the last part of our brighter giving process is review. So annually sitting down and determining exactly what your RMD was and making sure that required minimum distribution was met. Reviewing again what your annual desire for your contribution to your charity was, and make sure that is met. And ultimately just make sure that your assets are still in place and accomplishing the thing that you want them to accomplish. So this process working together adds a lot of peace of mind and stability and automation to a retirement plan. Thank you for joining us today. I hope you've gained a little bit of insight on what a QCD is and if it's a right fit for you. We appreciate you watching these videos. Subscribe below and join us again next time as we dive into your finances and seek to enlighten your retirement. Thank you.